Truth is, I thought it mattered. I thought that
money
mattered. But does it bollocks? Not compared to how people matter.
Welcome, Mention and other fine folks, to the Someday Dispatch of the Black Letter, where we contemplate thoughts worth thinking as we navigate this upside-down, topsy-turvy world, seeking greener pastures on the other side, come out healthier, wealthier, and wiser. And today we were going to take a look at the Fed, obviously. They had a meeting yesterday afternoon, so we'll see if there's anything of note there. And we'll also take a look at if negative interest rates are really going to be helpful. I'm also going to show you one of the debit spreads that I closed at a loss. So those continue not to perform exceptionally well for me currently, obviously because of the downdraft in the market at the moment. We'll see what happens. I have probably half a dozen or seven still outstanding. We'll see if I end up being a winner overall. And first, at CNBC, Fed holds rates steady near zero and indicates it will stay there for years. The Federal Reserve concluded its two-day public policy meeting Wednesday by voting to keep short-term interest rate anchored near zero. In addition to the expected move to hold the line, the Fed also provided specific language about its intent to hold rates low until inflation increases. The Federal Open Market Committee also adjusted its projections for GDP, unemployment, and inflation. Take a look at some of those numbers here. Short-term rates would remain targeted at 0 to 0.25%. Officials also changed the economic forecast to reflect a smaller decline in GDP and a lower unemployment rate in 2020. So things are improving, folks. We've got that V-shaped recovery. Nothing to see here. We're back to the races. The committee now sees a full-year GDP decline of 3.7%, considerably better than a 6.5% drop forecast in June. However, it lowered its 2021 outlook to 4% from 5% and 2022 to 3% from 3.5%. The committee expects 2.5% GDP growth in 2023. So what they're saying basically here is if we get 4% GDP growth in 2021 and we do see a 3.7% GDP decline for this year, then of course we've made up. We're actually ahead of where we were this year. So it means that in 2021 we'll be up to basically where we were, or close to where we were in 2019. So I think that's ridiculous opium smoking, and that's of course what they're here to do, right? Or rather, should I say this is what they are doing, perhaps not what they're here to do, but just to juice the numbers, massage them, and give us more opium, right? Keep us addicted to that nonsense. Here you can see these are what they're suggesting. This forecasting is just ridiculous. In fact, we'll ask the online oracle. Probably has as much information and legitimacy as to what's going to happen as these clowns. So we'll see if the oracle agrees with them or not. The unemployment rate projection also was brought down to 7.6% from 9.3%, which is already above the 8.4% jobless rate for August. And of course, we know that number is nonsense. The committee also marked up its inflation projection for 2020 to 1.2% from 0.8% in June, though it still does not see it hitting the 2% goal until 2023. I mean, these jobless numbers, unemployment rates are just ridiculous. They're massaged. They're not realistic. We've had 30 million people still almost with continuing unemployment claims. I don't know how they can suggest that things are at 8.4%, right? Just nonsense. And this as well, of course, they're going to lose their handle on inflation. And by 2023, I wouldn't be surprised if we're seeing upper high single digits, if not 10% or 11% or so. But we'll see. All right, on to different news about the negative interest rates from Reuters. Don't do it. Studies flash as sub-zero rate warnings to central banks. 6 years after the ECB cut interest rates below 0%, behavioral finance gurus have a message for other central banks thinking about taking the plunge. Don't. Rates in the United States, Britain, Norway, Australia, New Zealand, Israel, and Canada are at or below 0.25%, 25 basis points, so chances are one or more of their central banks will go sub-zero to try and counter the pandemic-fueled economic funk. New studies, however, seem to reinforce what some policymakers have long feared. Negative rates are ineffectual and perhaps even counterproductive. If your goal is to motivate people to take on more leverage or debt and to increase investments in risky assets, then zero interest rates are actually more efficient than negative rates, said Lior David Purr, head of Israel's State Debt Management Unit. And of course, this is exactly the kind of crazy world we live in, where everything's juiced by debt. Of course, the Bible talks about the borrower being slave to the lender, but of course none of that matters nowadays. everybody needs to get into debt for the good of society, right? It's your patriotic duty. We're going to saddle generations and generations with debt that they can never pay off. And that's just going to take a drag on the economy, in my opinion, at the best case. The highest positive impact on risk-taking and borrowing behavior was achieved when rates fell from 1% to 0%, pretty much where we are. So this is as good as it gets, I guess. The cost of negative rates for Sweden's economy likely outweighed the benefits, and this is what Sweden had done. And so last year, Sweden lifted its main rate back to 0%. Borrowing did rise when rates were negative, but money ended up invested mostly in housing, doing what? Inflating property markets and household debt and creating these bubbles. And I mean, we already have a problem with household debt, household mortgages being in bubble territory as well as the stock market. So imagine encouraging people to take on more debt and paying them for that. It's asinine that we can even think this way. It's not like you borrow and you buy a car or something that adds to GDP. When you borrow to buy housing, you don't get that stimulus effect, he said. This is Frederick Anderson, Associate Professor at the Lund School of Economics and Management. So we'll see if things do go to negative here in North America or in some other places, and we'll see what in fact happens at that point, I suppose. Fed to continue at least $120 billion in monthly QE to support flow of credit to households. Yeah, because that's exactly where this money is going, right, as we've seen before. So the FOMC stated, over coming months, the Federal Reserve will increase its holdings of Treasury securities and agency mortgage-backed securities, at least at the current pace, to sustain smooth market functioning and help foster accommodative financial conditions, thereby supporting the flow of credit to households and businesses. And they talk a good game, pity they can't walk their talk. The noble Fed is doing QE for the kids, not to keep stocks levitating. Yeah, exactly. Maybe Powell can explain why, as Bloomberg reported yesterday, just 0.2% of the Fed's Main Street lending program has been used. And we took a look at that, didn't we, right? $80 billion in monthly Treasury purchases and $40 billion in monthly mortgage-backed security purchases will continue indefinitely. So this is going to continue to rise indefinitely, I guess. But everything is great, right? I guess you have to just laugh, nod, and smile about this whole disaster that we're in. And they're, in fact, fueling the flames, in my opinion. There you have it, folks. Some interesting tidbits. Keep your powder dry. Don't take on more debt, in my opinion. Again, none of this is financial advice. Salt away some savings, some gunpowder, dry powder for when we do get opportunities, which will come at some point, I imagine. And if they don't, there's nothing wrong with being a saver, right? Okay, so we thought I should check out the jobless claims here. Jobless claims were lower than expected, but unemployment growth is still sluggish. First-time claims for unemployment insurance totaled 860,000 last week, so I guess quite below the 1 million I was expecting. And that was down from the 893,000 a week ago, and better than the Dow Jones estimates of 875,000. Folks, I just, it's interesting to look at these numbers, but these numbers are hard really to ascertain. I think these numbers might be manipulated now as well. It's just, and I'm not one to discount media. I think media is very important. The fourth estate, if you will, is extremely important for a functioning democracy, but I just can't honestly believe all these numbers, because these numbers are coming from government agencies, and this specific government is untrustworthy in my opinion. So who knows? We'll see if we get further clarity from this from some of the other bloggers out there who take a look at these numbers more closely than I do and see what's really going on. But I think ongoing claims are probably still up around that 29-30 million. We'll see what happens. Regardless, these are atrocious numbers, 860,000 people. This is going on for weeks and weeks. We've had over 800,000 people with first-time jobless claims for, I think this is 23, 24 weeks now. I forget. It's just astonishing. Continuing claims fell by more than 900,000. Again, I can't believe these numbers at face value. I mean, look at this. This is, I don't know how many weeks is this. I suppose I could count it. I'm not inclined to, though. Okay, I also wanted to share with you the debit spread, of course, I was talking about earlier. So I got into AAP here, Advanced Auto Parts, roughly around, when would this have been? The 25th of August, I guess, after they had done better than expected substantially on earnings call. And of course, people, it had shot up and then come down of profit taking, and one expects it to sort of perhaps continue to improve. That has not been the case, as you can see. So I think it was around here or here I got out. And anyway, so that was a loser. Got a bunch coming up here too. There's F5 Network, as I've mentioned to you as well. Again, did better than expected on their earnings call, but there was a lot of profit taking. I thought it was oversold, and so when I got in here, I thought I was getting in at a good price, again around the 25th of August, expecting it to continue to head upwards. That has not been the case. This is going to be a full loser as well. So far, including this one, that's 12 debit spreads I've done so far in the last few months. And out of those 12, 3 are full losers. 1 I got out as at a scratch, and 8 have been winners so far. So not too bad, but we'll continue to see. I have, as I said, I think 6 or 7 still outstanding, and it looks like they might be under pressure too. I'm not sure how many of those will be winners. We'll see what happens if this bloodletting continues. Of course, I'm expecting a huge crash, and maybe we're not going to get that crash. Maybe this is just the general erosion, downward trend of a bear market that we'll see for the next few years. I don't know. Time will tell. I think there's going to be a lot done to prop up the markets until the election at least, so perhaps there'll be some juice added, and some of these debit spreads I have outstanding might turn into winners, but there you have it. Okay, on to the markets and themselves. All right, here we are. So actually under quite a bit of pressure here, you can see all 3 indices down by over 1%. S&P 500 down by 1.44%, NASDAQ down 1.25%, and Dow Jones by 1.2%. This means it's likely to end up being a red day, I would imagine, unless there's a big buy-in later this afternoon, but we'll see what happens. And here's gold still consolidating, interestingly, even on a deep red day in the market. So it's going to continue to do that for some time, perhaps. And silver is likely to mirror this. And there you have it. Silver also consolidating. Really nice pattern that's setting up here too. At some point is going to break out, I imagine, probably within the next handful of weeks, I would think. But who knows? I mean, nobody can guess the future, right? Okay, so the markets, cryptocurrency markets down by 0.7%, 350 billion market cap currently, and 5,905 coins for your purchase and pleasure. Bitcoin at about 56.8% market cap dominance. Interestingly, Bitcoin is still sort of tethered to the stock market to some degree, it looks like, sort of following the ups and downs there. I imagine eventually it'll untether from the stock market, but who knows? Currently it's sort of been mirroring what the stock market does, it seems. Ethereum not, of course, being up. XRP up as well, and Polkadot as well. Otherwise, a lot of red on the board here as well, as we can see. Cardano up a bit, as well as EOS. Stellar down substantially. Not sure what's going on there. There you have it, folks. So, yeah, mixed bag. Yearn Finance down pretty decently, but still quite a high level. I'm not sure about Yearn Finance. I haven't looked much into it. As you know, I'm focusing primarily on Bitcoin. All right, on to the online oracle for today's most pressing question. All right, so one of the first articles we looked at, the first article I think, was the Fed information here, where they were talking about the committee seeing a full year GDP decline of 3.7%, considerably better than the 6.5% drop forecast in June. So I thought that would make a good question for the online oracle. The 8-ball economist, our trusty sidekick. Will full year GDP decline be more than 4% for 2020? I don't know about that, but we'll see. Signs point to yes. Okay, so folks, the online oracle is suggesting that the Fed is talking nonsense, and I have a tendency to agree. I think we will have probably maybe between 4 and 6% decline GDP over the year fully, and we'll see what happens. The Fed, as we just mentioned here, is thinking 3.7%, so we'll end up seeing who's right. Probably won't find that information until perhaps first couple months in 2021. There you have it, folks. Thanks so much for joining me. I appreciate you, and I hope you have a wonderful day. Take care of each other out there. Pay down debt, squirrel away some savings. Good times are coming at some point, and the opportunities for value investing will return, I'm certain. In the meantime, build up your dry powder, as they say,